Welcome to the Deep Dive. This is the show where we cut through all the noise, the market commentary, the research reports, all of it. We take that whole stack, find the most essential, actionable nuggets of knowledge, and we deliver them right to you so you can be instantly and, well, thoroughly informed.
And today's deep dive is, it's really all about a kind of market schizophrenia. We're seeing this powerful, immediate conflict where financial market expectations, the hope for easier monetary policy, are just running headfirst into some really worrying signals from the real economy.
That's the core tension, isn't it? You've got these rate cut hopes colliding directly with mounting stress in huge sectors like housing and construction, and then you add in the growing signs of softness in the labor market. The market tried to latch onto a hint of Fed easing, but that optimism, it just couldn't hold up.
Exactly. And that's the dynamic we really need to break down. Because when the Fed speaks, that's a verbal signal. But when the market trades, especially in the cash session, that's a behavioral signal. And when those two signals contradict each other, well, that tells you investors are deeply, deeply uncertain about where growth is headed.
Okay, so let's unpack this. Let's start with the specific event that kicked off all that optimism. New York Fed President John Williams. He gave some commentary that really signaled a shift in tone. He described policy as only, modestly restrictive?
Yeah, modestly restrictive. And he suggested there was room for a near-term adjustment toward a more neutral rate.
And those terms, they matter. They matter a lot.
Oh, profoundly. When the Fed says neutral rate, they're talking about that theoretical interest rate that isn't stimulating the economy, but it's not restricting it either. So if Williams says policy's only modestly restrictive now, that implies the Fed doesn't think they have much further to go, and any shift would be back toward that neutral zone probably sooner than people thought.
So it changes the whole narrative.
Completely. It shifts them from being inflation fighters to growth managers.
And the market reaction was, it was explosive. Textbook, really. S&P 500 and NASDAQ futures, they just swung sharply higher overnight. The market was suddenly pricing in a high probability of a quarter-point cut as early as December.
But the momentum traders jumped right in. They're thinking, okay, the Fed blink is real, peak rates are behind us, let's go.
But then came the cash session. And this is where it gets really interesting if you're trying to read the market's real conviction.
Right. Despite all that dovish talk, despite the futures rally, the actual cash session ended the day with broad equity losses. The S&P, the NASDAQ, they sold off sharply.
And that reversal says so much. If the Fed is hinting at cuts, that should be bullish for stocks. Yeah. So why are the most sensitive parts of the market, growth and tech names, leading the sell-off?
It boils down to two related fears. First, the trading itself was just classic risk-off behavior. Growth stocks and small caps, they led the losses because investors started discounting that rosy scenario and focused on the bigger worries.
You mean the long-duration growth names? The ones whose profits are way out in the future?
Exactly. The prospect of cuts should help them. But if the cuts are only happening because the economy is crumbling, then those future earnings might not even materialize.
So they're selling this story because they're more afraid of the reason for the cuts than they are excited about the cuts themselves.
Precisely. You saw the money move into safety. Oil fell again, dropped almost 1.6%. That suggests real worries about future global demand. Meanwhile, gold quietly ticked higher, doing its job as a flight to safety asset. Even the small moves in currency. A slight lift in sterling, a dip in the euro. It all suggests investors are de-risking, not embracing a big rally.
Okay, so that fear on Wall Street, it has to be rooted in real data from Main Street. And we've been watching this slow grind, but now it seems there's a new, more dangerous dynamic at play. Housing and jobs are starting to feed each other lower, a real downward spiral.
This feedback loop is the absolute core of the slowdown argument right now. Let's start with housing, which, has been under pressure for what feels like forever. 3 years, you'd think, with mortgage rates easing off their peaks and income growth being pretty robust.
Right, you'd think builders would have found their footing by now.
But the data just shows the opposite. They can't stabilize their margins without offering huge incentives, buying down rates, throwing in upgrades.
Oh, they're cutting back.
They're cutting back hard. Fewer land purchases, fewer new projects, and the big one, significant cuts to headcount. That is the behavior of a sector that is aggressively, actively contracting.
And the missing piece for a recovery there is confidence. Confidence in the labor market.
That's it. Headline unemployment, 4.4%. It still looks manageable on the surface. But that's what we call a lagging indicator. It's a rear-view mirror metric. If you look at the leading indicators, they're screaming a very different story.
Like the mass layoff notices we've been seeing.
Exactly. Filings for mass layoffs have spiked to one of the highest levels in 2 decades. And on top of that, we know Fed officials are actually expecting downward revisions to the job growth numbers from earlier this year. It all points to a softening that just isn't in that clean unemployment rate yet.
I have to play devil's advocate here, though. Aren't those layoff filings historically pretty volatile? Couldn't we be overreacting a bit to data that hasn't shown up in the big number yet?
It's a fair challenge, but this is why you have to look at the connections. Worker surveys, for example, show people feel much more insecure than the data implies. And that feeling, that insecurity, that's the transmission mechanism for the slowdown.
So when people are worried about their jobs,
They delay the big decisions,
Oh.
like buying a house. It doesn't matter if the mortgage rate drops 50 basis points. If you're worried about losing your job, that 30-year commitment is just, it's off the table.
and that caution from households feeds right back into the employment problem for the builders.
It's the perfect loop. Reluctant buyers mean builders face more pressure. We're seeing price declines in over half of U.S. homes by some measures. That confidence just isn't there. So builders, their margins are getting squeezed, and they pass that pain right down the chain to suppliers, to contractors. We're seeing price rebids, staffing cuts. The whole ecosystem is feeling it.
And what's so powerful about this is that construction is a small part of total employment, but it's such a crucial leading indicator historically.
It really is. Stress here usually precedes broader weakness in the service sector. And this raises the critical question for the Fed. If they wait for a clear break in the official lagging data, wait for headline unemployment to spike above 5%, this self-reinforcing loop may have already pushed the economy much further down than they intended.
That macro tension really sets the stage. But to understand what's driving investment decisions right now, we need to shift focus a bit and look at 4 other critical narratives. Let's start with geopolitics and oil.
Okay. So crude prices took another big leg down. Brent is now down more than 16% for the year. And the immediate trigger for this latest move was reports about a proposed peace framework for Ukraine, apparently drafted by the Trump administration.
The one suggesting territorial losses for security guarantees.
That's the one. And even the idea of a credible path to de-escalation, no matter how politically fraught, is enough to just yank the risk premium out of the energy markets.
And for investors, that cuts both ways.
It really does. Short term, it drags on energy sector earnings. They need those higher volatile prices. But longer term, structurally lower crude prices feed right into core inflation. And that is a huge green light for central banks everywhere to ease policy without worrying about another energy price shock. It buys them time.
Okay, next up, corporate strategy. Let's talk about Citigroup's big internal restructuring. This feels like more than just moving boxes on an org chart.
It's a structural attempt to fix a problem that's been around for a long, long time. Citi has historically traded at a big valuation discount to its peers like JP Morgan or Bank of America. They've struggled with complexity. So this restructuring is very specific. They're elevating U.S. consumer cards to be one of their 5 core businesses.
And what's the logic there? Why consumer cards?
Because cards are a massive earnings engine if you manage them tightly. High margins, tons of data. By elevating them, Citi is signaling where they're going to focus capital and leadership. And combining wealth management with retail banking is all about streamlining operations. The goal is to prove to the market they can be simpler, more focused, and hopefully close that valuation gap. It's a big bet on simplification.
Story 3. This is about positioning in the biggest trade of the decade, the NVIDIA tug of war. We saw Cathie Wood's ARK Innovation ETF buy, over 93,000 shares of NVIDIA after that post-earnings drop?
Yeah, and it lifted the position into their top tier of holdings. It was their first purchase since early August, and it just perfectly illustrates the behavioral split in the market. ARK represents the long horizon thematic investors. They believe in the AI shift, and they're using this volatility to build their positions on weakness. They see dips as a gift.
While at the same time, you have the more tactical funds.
The ones focused on quarterly returns, yeah. They're cutting exposure. They're worried the trade is too crowded. Valuations are stretched.
So the question for you, the investor, is which group is right?
Exactly. Is this a pause before the next leg up, or is this the start of the big unwind for the crowded AI trade? The outcome of that tug of war will really shape market leadership going into next year.
Or finally, the global chip race.
Yeah.
It's really become about national security and intellectual property. Intel's CEO had to come out and aggressively deny reports that a new senior hire from TSMC might have brought proprietary knowledge with him.
And this is serious. Taiwanese prosecutors and even TSMC itself have opened inquiries. This is corporate competition, but seen through a geopolitical lens. In advanced chipmaking, the IP, the process knowledge, is the only competitive advantage. When talent moves, it's now seen as a potential breach of national technology assets.
It just shows how fragile the trust is in these strategic supply chains. So we've covered the conflict between market hope and economic reality. We've hit the key corporate and geopolitical stories. For you listening, what are the key indicators to monitor over the next few weeks?
First and foremost, Fed communication. Pay attention to everything they say leading up to the December meeting. We need to see how they explicitly balance those inflation worries against the stress in housing and construction. If they start sounding more worried about jobs than inflation, the market will price in cuts very, very aggressively.
We also need to see if that housing jobs loop is getting worse or if it's finally starting to stabilize. So watch construction employment data and maybe look at REIT deal flow too.
Yes, let's clarify that. When we say REIT deal flow, we mean the buying, selling, and financing activity in large commercial real estate investment trusts. If those deals are drying up, it signals serious trouble in commercial property, which then hits the banks and broader investor confidence. It gives you a window into the health of the entire real estate capital structure.
And on the tech side, we're watching corporate IT spending.
Absolutely. We need to see guidance revisions from cloud and SaaS companies. Updates from firms like Viva and its peers will tell us if enterprise software demand is slowing down. Our budgets being frozen because of higher rates, that's a huge tell about corporate investment.
And finally, circling back, we've got to watch the oil price reaction to any more peace headlines from Ukraine.
Right, that directly impacts inflation expectations. And also keep a very sharp eye on the outcome of those semiconductor IP investigations in Taiwan and the US. How that gets resolved will signal how aggressively regulators are going to police talent moves in these strategic sectors from now on. #tag outro rage.
Wow. A dense and really complex set of signals to track. So to quickly recap the central takeaway, the market is caught between what it expects, the Fed riding to the rescue with rate cuts, and the economic reality, which is that stress is visibly accelerating in those foundational sectors, housing and construction.
And that leads us right to our final provocative thought for you to consider. Given that stress in construction historically comes before broader weakness, what are the real implications if the Fed waits for the official lagging labor data, that headline unemployment number, to break before it acts? Should you, right now, be trusting the leading indicators, like the layoff filings and housing pressure, more than the official smoothed-out statistics? It completely changes your perspective on how deep of a slowdown we might be facing.
It's something to mull over until our next deep dive.
Yeah.
Thanks for tuning in.